All right, hello everyone. Welcome. I'm Albert Liu for a Rule Classroom live stream. Welcome to anyone joining us on Twitter X or YouTube. Visit ruleclassroom.com for more interviews like this one. Today, I'm pleased to welcome back Mr. Jason Jessup, who is CEO of Magna Mining and was the focus of our first Do Your Diligence episode back in June when Rick Rule went one-on-one with Jason to discuss the prospects of his companies, holding no punches back. That was a great episode. And now Jason is back with some new developments. So I want to bring back Jason, but first I want to throw it to Rick Rule for some introductory remarks. Rick, great to see you. How are you?
I'm fine, Albert. We have a busy day today. In addition
We
to this, I think we
absolutely
have two.
do. For those of you out there, we have Jason right now, but then Ross Beaty coming up at 8 a.m. Pacific time. So, Rick, what are you and Jason going to be talking about today?
Well, you'll recall, Albert, that we did a special session with Jason, Do Your Diligence. The idea being that we allow the Rule Classroom members to watch due diligence conducted live, learning how to interrogate companies around their presentation and how to make investment decisions. I think that was a wonderful session. We had Jason on at the suggestion of a longtime friend of mine, Jonathan Goodman of Dundee, with whom I've done business with for 40 years. Jason is exploring and developing in the Sudbury Basin the premier nickel, copper, cobalt, platinum group metals area in North America, a very venerable area. And importantly to me, Jason is located himself in Sudbury. He doesn't try to explore Sudbury as an example from Vancouver, but rather lives within the city limits of a town that has 2 smelters and 6 or 7 mines. And we had a fascinating discussion, I think, around in particular nickel projects. Current viewers of the Rule Classroom will know that nickel is deeply out of favor and hence of a lot of interest to me. And what attracted me to having the interview with Jason was the fact that despite really, really, really depressed nickel prices, the company had a couple of projects that appeared to me to be not just economic, but potentially highly economic in this price environment. And it appeared to me, too, that they could be the anchors of junior property consolidation in the Sudbury district. Today, Jason comes back and talks about advancing that strategy with a recent acquisition that they are doing from the number 2 producer in the Sudbury Basin, a potentially exciting development. But the devil, of course, is in the details. And Albert, hopefully today, we get to tackle that devil and get into the details.
All right, then without further ado, let's welcome Jason Jessup, CEO of Magna Mining, to the conversation. Jason, we're hoping to get some of those details from you today. So why don't you start with some introductory remarks, and then we'll get Rick back to, go into more detail with you.
Absolutely. And yeah, it's great to talk to you again, Rick. And, I'm thrilled to be here. Last time we talked, I think I was excited and optimistic about what the future held for Magna. And it's great today to be able to talk about the acquisition we just announced last week and our new PEA that we came out with earlier this week. So lots of exciting things happening at Magna and falling exactly within our strategy we've been talking about for years now. I can jump right into my presentation, Rick, unless you have a few questions to kick things off.
No, let's get right into the presentation, but I want you to give the presentation in the context of how these assets fit into your existing assets and
For
how,
sure.
if in any way, this changes the schedule and the capital requirements that we talked about in our previous discussion.
All right. All right. Well, if everyone sees my screen, I will jump right into it.
Yep, looks good, Jason.
Perfect. So Rick, as I was saying, our strategy has stayed the same basically since inception. It's all about near-term production, making new discoveries, and acquiring other properties and mines in the Sudbury Basin that are synergistic with our current team and our current assets. And what we've accomplished in announcing this signing of this definitive agreement to acquire the KGHM properties, it fits in perfectly with all of these, and it fits in very nicely with our existing Crane Hill project as well as Shakespeare. So I'm going to get into some of these details, Rick, but feel free to just jump in and ask questions. So the transaction, really, what is this? We were able to acquire a number of past producing mines and exploration properties from KGHMI. These were the former FNX properties, excluding the Victoria property, which KGHMI is going to keep. But it includes the producing McCreedy West mine, the Lac and Podowski Mine, which operated and went on care and maintenance in 2019 and in 2013, respectively. The past producing Kirkwood mine and 4 other exploration properties. To remind everyone, back in 2000 and from 2008 and then 2011 when I left, I was the running the operations at the McCreedy West and Lac Mine. So these are mines I know extremely well. I think when I was in charge of operations there, we operate them very efficiently, very productively. So then the question is, how much did we pay for all of this? And it is it took us a long time to negotiate this deal, a very long time, but we were able to come up with a deal I think that is unbelievable. So cash on closing of $5.3 million plus an additional $2 million worth of Magna common shares priced at closing. There's an additional $2 million payment, deferred payment before December 31st, 2026. And we're taking on approximately $10 million in closure liabilities. And there is also some contingent payments based upon future milestones of reaching commercial production on some of the non-producing assets. So, overall, very low cash up front, deferring some of that payment price, taking on some long-term closure liabilities, and then having some milestone payments. So, I believe for a company like Magna, this meets our goals and my goals as a shareholder, not to have a dilutive acquisition. I think we've done a great job negotiating this. So then the question is funding. All right, how are you going to pay for this? We had Desjardins as our financial advisors on this, and they were able to work with their lending team to provide us with a commitment letter for committed capital for a $10 million 3-year term loan, as well as a $10 million letter of credit facility, and that would be used to cover the closure liabilities. This is still subject to the final documentation, but it is committed capital within that company. So based on the purchase price and this commitment letter from Desjardins, we're in a position to close this financing without actually needing to raise any money. So this map that I've shown many times now, I'm so excited to be able to show the additional properties that would come with this acquisition. So, I've talked lots about Shakespeare and Crane Hill, as you see in dark blue, but then, the other properties are located around the Sudbury Basin and in the footwall of the Sudbury Basin, with McCreedy and Lac being connected next to each other in very close proximity to Glencore's Strathcona Mill. And McCreedy right now does have an agreement in place to sell nickel ore to the Strathcona Mill, and there are other copper ores selling to the Clarabelle Mill. But yeah, it's a nice mix and a nice spread across the basin. So what does this do for our company? I think it's such a transformational transaction. Being able to, upon closing, become a producing copper company with optionality to turn on nickel when the timing is right, I think really sets us apart from other juniors. And not needing a huge amount of capital to do that is pretty exceptional. And with the Lac and Podowski mine being on care and maintenance and in very good shape, it allows us that pathway combined with Crane Hill to move things forward. And potentially we have the ability to have 2025 production at McCreedy West mine, development starting with Green Hill, in 2026 restart of Lac Mine with production ramping up at Crane Hill, and then potentially following that in 2027 a potential restart of the Podowski mine. So by the end of 2027 there is potential to have 4 producing mines in Sudbury. So this again very forward looking, but it's very easy to see that pathway of growth, and having familiarity with the Lac and McCreedy mine. I believe our team, we're highly confident in what we can do with those 2 assets, and the work we've done on Crane Hill. We're very, very optimistic that we can move that forward. With the permits we have, all the drilling and knowledge we have, and the near surface resources that we could mine. Yeah, we just think that again, it's a very low risk type development. One of the great things that I haven't spoken a lot about is the operational synergies. So as we've spoken before about Crane Hill and what we'll need to move that forward into commercial production, there's a lot of things we'll need. We'll need a complete team. We'll need procurement. We'll need health and safety policies. We'll need the accounting back office to operate the mine. There's a lot of things we'll need, but with this acquisition, we are acquiring that. We're acquiring a full team right up to the mine manager and manager of technical services at the McCreedy West mine, and we can leverage that at Crane Hill, which is not just de-risking, but it's also going to have some great cost savings. As well, there's a lot of equipment that we can use with this acquisition that can help us reduce the capital cost potentially at Crane Hill. There's a mine power center that was never installed. It's in storage at Lac Mine. That's exactly what we need for hooking up to grid power at Crane Hill. There is a sample tower at Podowski that we could use early on at Crane Hill to help reduce that pre-production capital cost. There's ventilation fans for the underground at Podowski that we could use again to reduce that. So there's potentially millions of dollars in operational synergies between the acquisition properties and Crane Hill. Now the resource growth, and I'll get into that a little bit, but we've come up with our own NI 43-101 resource that we announced with the signing of the definitive for the McCreedy West mine. It sits at about 9.3 million tons, and I'll get into that a little bit more. There's also an additional approximately 17 million tons of historic resources on the other properties. Combined with the new resource we put out, the new underground resource for Crane Hill, that's over 18 million tons in the indicated category. We're starting to grow a very significant critical mass of resource to mine in the future. And then the exploration potential. Our team, is largely made up of the former FNX employees, including some of the people like Dave King, who have made some massive footwall discoveries while they were with FNX. Having these properties like McCreedy West and Lac on the North Range, I couldn't be more excited about the footwall exploration potential, which was not a focus for KGHM at all. We're really excited to get some drills turning there. So a little bit, just very quickly before I jump into some verify slides. So McCreedy West was an old Inco mine. It operated from about 1970 to 1998, shut it down. FNX reopened it in 2003. In 2023, produced 317,000 tons at about 1.6 copper, a little bit of nickel, and about 2.5 grams. It was a mine that was very non-core to KGHM. So there was, just enough capital put in place to continue production, but no growth capital put in place. And that's an opportunity we see that, we can grow this production. To speak to when I was operating this mine back in 2008, around the time the financial crisis hit, we had to downsize. We laid off some people as nickel and copper prices collapsed. But at that time, we were mining approximately 2,500 tons a day from McCreedy West mine. Currently, they're mining about 900 tons a day. And the mine is no deeper than it was when I was operating it. So it is, there's still a lot of resource, easily accessible, and potential to ramp up production quite a bit from what it currently has done in the last couple of years. So we'll get right into the McCreedy West mine. You can see the properties are right next to Lac Mine. They're actually connected underground. As I mentioned, the resource that we just put out, 1.1 at a 1.1% nickel equivalent cutoff grade, 9.3 million tons. This is made up of three different zones: the intermediate nickel contact zone, which is primarily nickel, the 700 Footwall Zone, which is a copper PGM zone, and then the PM zone, the precious metal zone, another footwall deposit discovery made by FNX Mining, which is PGM rich, low sulfide copper zone, very similar to the 109 footwall zone at Green Hill. So if we look at this nickel contact zone, this was something that FNX mined quite extensively up until 2008. There's been minimal mining done since then. Most of the focus has been on the copper zones over the last, call it 12 years or so. But as you can see, there is some extensive resources left, and also some good grade lenses. So you can be selective in this area and mine some pretty good grades. Typically, back in the FNX days, we mined 1.3 to 1.5% nickel, but there was months that we got in and mined over 2% nickel. But right now, that is not the focus. That's the optionality. And when the timing is right, when we see the next run in the price of nickel, this is a nickel ore body that has infrastructure in place, stopes that are ready to drill off, and the nickel can be turned on very, very quickly. Currently, you can see the resources that are up there. So, pretty significant, over 2 million tons of resource currently, and definitely potential to expand on those. Now, the PM zone, as I mentioned, is a zone that FNX discovered, and we developed back in from about 2005 to 2000 and 2000 and, well, they're still mining it, but it was probably all developed mostly by 2009. It is a lower sulfide type deposit, has some, very wide zones. You can do some bulk mining. Typically we would operate between 0.7 and 0.9% copper, a little bit of nickel, and 4 to 5 grams in a bulk mining scenario. And, and this is still a zone that we believe has a lot of potential for expansion.
Excuse me, Jason. Yep. When you refer to 4 to 5 grams, 4 to 5 grams of what?
Yeah, platinum, palladium, and gold combined. Most of the weighting is on palladium.
Yep. Thank you.
No problem. But really, what has been the focus over the last number of years is this 700 footwall zone. And this is an area I know very, very well from my days at McCreedy West. It's just an amazing zone, still with over 5 million tons of NI 431 compliant resource, at a 1.1% nickel equivalent cutoff, just under 2% copper and about 0.7 nickel with, a 2.5 grams again, or a little better than that in PGMs. Great zone. When I was operating the mine, we mined this zone narrow vein very selectively at lower throughput rates, only about 3,000 to 5,000 tons a month, but at close to 5% copper plus nickel and PGMs. The philosophy with KGHM has changed, where they're going in and bulk mining, and that's 317,000 tons they mined in 2023 was mostly from here with a little bit of PM zone mixed into that, but mostly from the 700 complex bulk mining. So what we saw was there's a lot more dilution than I think we would want to accept going forward. We would want to refine some of these stopes and hopefully be able to come out with a mine plan that can increase the copper grades in this area, as well as at least modestly increasing production, in the first 12 months. So that will be our focus. But as you can see from some of these intersections, if you can see them on the screen, maybe I can zoom up a bit. Some of these intersections where you have, close to 8 meters at 11% copper and 1.2 nickel, a number of areas where, there's some high PGMs with both nickel and copper. And, typically these veins will run anywhere from, 2 to 5 meters wide. And, there will be little stringers running off of them. So you can do some bulk mining, but I think being a little more selective, we can get some very high grade copper out of this. And there's lots of it there. So even at potentially a 350,000 tons to 500,000 tons a year, potentially many years of mining still just in the 700 complex alone. So Lac Mine, and this is a mine that's it's got a special place in my heart. I really enjoyed my time. I'm running this mine. It's a long life historic mine, produced over 60 million tons. And obviously most of that during the years Inco ran it. FNX really focused on the Levack footwall, which was later called the Morrison Deposit after Gord Morrison, who's one of our senior advisors. But it is it has all the classic with, contact nickel, high grade copper footwall, and we think a lot of exploration potential. One thing just to note, if you look at the resources, and we'll talk a little more about it, but over 5 million tons of indicated resource, and the contact nickel grades are quite good at Lac Mine, with over 4 million tons at 2.1% nickel and 1.1% copper. So the McCreedy West Mine and Lac Mine are connected. Lac, the shaft is still utilized every day. It is the secondary egress for the McCreedy West Mine, as well as for Glencore's neighboring mine. So it is in good shape. We could go and drill from there on day one from underground if we wanted to. And we will be looking at a restart plan for this throughout 2025 for potentially a 2026 restart. So I talked briefly about the contact nickel resource. That's in red, as you can see up here, the main zone, number 7, intermediate zone, number 3 ore body, the number 1, 2 ore bodies. It's a pretty extensive. A lot of these upper levels were originally track drifts. They were mined back in the 20s, 30s, 40s. Our plan, and this is a plan I actually had in place back in 2011, just prior to leaving Quadra FNX, when I was at Lac Mine, was to drive a ramp from surface, which would give access to a lot of these upper levels that otherwise are very difficult to access with modern equipment because of the size of the drifts there. So again, some really decent grades of contact nickel with some good copper in some of these zones, and enough to build a mine plan and develop a ramp down to connect to the existing ramp that is at the 950-foot level. So a 950-foot ramp would allow us to access the upper levels of the contact nickel, as well as some of the upper footwall mineralization, which I'll talk about in a minute. But we'll also give ramp access right down to the bottom of the Morrison deposit from surface, which gives a lot of flexibility and could potentially help lower operating costs quite a bit. So the Morrison deposit, which I had the privilege of leading the team to bring that into commercial production, it has been produced some very, very high grades. The resource to the left is still a decent grade at about 4.2% copper, over 700,000 tons. You know, some of that is very remnant and it's probably not economic to extract, but there is a portion of it that we will look into going after. And again, it has ramp access, quite easily accessible and connected to neighboring mines that have potential to hoist that ore, as opposed to bringing it up through the Lac Shaft and hauling it up that ramp. But again, this will be what we'll be looking at in 2025, coming up with a proper restart plan. Now, Rick, you asked about the exploration potential, and again, this is getting us really, really excited as we've been digging into this over the last year. What we're seeing, so the Morrison Deposit, it was discovered and we developed it, fairly rapidly. But just prior to discovering the Morrison Deposit, FNX drilled a zone up near surface. And if you can look up near the top there, one of those intersections in what's called the Keel Zone, um, there's intersections up there that are massive chalcopyrite veins in the footwall of the main zone. And we believe that there's potential for this type of footwall mineralization to extend all the way down to the Morrison deposit. Now, obviously, it's not going to be one continuous vein, but this breccia unit in the footwall appears to have mineralization throughout it. So, getting in there, understanding it, doing some more drilling from underground, and focusing on more selective mining could be, some great high-grade sweetener to mix into the overall production plan. As I mentioned, one of the things I looked at in the past, and actually we had designed a ramp that KGHM never developed, but to come from surface, and we would come right by this keel zone, which starts currently around the 400-foot level, but potentially that could come nearer to surface. Get in there and start doing some silling on those veins to better understand them and hopefully expand on it. But that's something that could happen, very, very early in the restart. So that's pretty exciting, as well as the excitement of coming from the Morrison deposit, the Levac footwall, and looking at some mineralization that's coming up heading towards that keel zone. And again, I'm not going to read out all these intersections, but I think if people read them, it speaks for themselves. These are the kind of grades that you don't see very often outside of Sudbury. So there's quite a distance, about 2.2 kilometers, if you look on dip from the PM zone at the McCready West mine to the Morrison deposit. Our interpretation is that breccia zone continues right to the Morrison. And there's been almost no drilling done in this area. Now, back in about 2017, KGHM drilled 3 holes from that 1600 level track drift. And one of those holes hit a 2-foot wide vein, about 0.6 meters, of over 30% copper and 4 grams of PGMs in one of these breccia zones. So, and that's about, I think, approximately 280 meters outside of the existing PM zone resource. So that's a pretty big step out. And like, there's never been followed up on by KGHM. It was just not big enough for them. Again, they were not focused on exploration, but that tells us there's potential for more high-grade footwall mineralization in this Brete Corridor, and there's a lot to explore. And that 1600 level track drift gives us a platform to potentially drill that off. So, the upside and the potential to find another significant footwall deposit in this 2.2 kilometer trend between 2 spectacular mines, 2 spectacular footwall deposits, I think is pretty good. So it doesn't stop there. And Rick, please feel free to jump in because we got a couple more properties to talk about. But so our Podowski mine that we'd be acquiring when this closes is, again, a mine that was an old Inco mine. It operated as an open pit called the Whistle Pit. That was closed and rehabilitated. FNX explored it and discovered a very high-grade copper deposit called the 2000 deposit in the footwall. And they also had discovered the North Zone on surface. A ramp was developed partially into the North Zone, but did not reach the mineralization. It was halted in 2008, but a shaft was sunk in the 2000 deposit operated from 2013 to, or sorry, from 2008 to 2013. You know, current resources sit at about 6 million tons of contact mineralization below the old open pit, and then an additional about 1.5 million between indicated and inferred in some of these footwall zones. This just shows the layout of the different zones and the shaft. Again, the 2000 zone was a spectacular deposit, massive chalcopyrite. The North Zone also has some very high grade, although it's more pinch and swell, narrow vein type veins. And you know, currently the underground workings are flooded, but you know, the head frame, the hoist, you know, the infrastructure on surface still kept in good shape. And the mine is on care and maintenance, and potentially the ramp could be extended and be able to access the North Zone to restart mining there from surface. And you know, it could ramp over, which is the original plan, to below the pit to mine some of that contact nickel that's below the pit. So this North Zone, it does come actually right to surface. As you can see, again, you know, there are some areas in it that are very high grade with over 20% copper over some decent widths, but it is very pinch and swelling. It's not, I would not say it's not a suitable to bulk mining if you want to keep the grades up, but it is something that we're looking at. If we were to talk about sort of priorities, you know, our priorities are going to be, you know, optimizing McCreedy West, bringing Crane Hill, you know, starting Crane Hill development towards production, restarting Lac Mine, and then once the three of those are running, then looking at a potential restart on Podowski. And again, although the overall resource in the contact zone is about 6 million tons at 0.75 nickel, there are some, you know, higher grade lenses and zones within that potentially, you know, could be mined underground and produce higher grade than what the overall resource is. Again, these are historic resources. Only McCreedy West has a NA 43-1 compliant resource. The others are all historic. And Kirkwood, again, was a past producing Inco mine. It was one of the mines FNX really didn't have time to do a tremendous amount of exploration on. They discovered the PM zone, they discovered the 2000 deposit, the Morrison deposit, and the Victoria deposit, which KGHM is keeping. You know, when I talk to people like Gord Morrison about, you know, why didn't you do more work at Kirkwood, he just says we just never got around to it before, you know, we were acquired. But they did do a little bit of work there and had some success, and we think there's still potential for, you know, more discovery at Kirkwood. It's located right next to the town of Garson and right next to Vale's Garson mine, in a great place, a couple kilometers away from Vale's Frood and Stobie mine, which is a monster mine that operated for over 100 years. Now, in purple, that's the SIC contact. That's where you'd find the contact mineralization. And this blue color is the South Range Sudbury Breccia Belt. And that's what hosted the Fruit Stobie mine. And there's a significant amount of it that has been really not explored at all. So again, these are historic resources. I'm not going to get into all of it, but you know, there are, call it, plus 2 million tons of historic resources there. But what our real focus will be is in this zone that FNX discovered, and it's called the Segway Zone. It's a small, right now, small footwall zone, comes right to surface, you know, with some intersections close to surface that run, you know, approximately 5% copper, a little bit of nickel, less than 1% nickel, and about half an ounce of platinum, palladium plus gold. Again, only a handful of holes drilled in this area, but it does tell us that the Sudbury South Range Breccia Belt does have potential to host footwall deposits. So again, it'll be one of our key exploration properties in the next couple of years. As well, there's 4 other properties that will be acquired that are early stage exploration. I'm not going to get a lot into those. There's a lot to talk about here, but overall, with this deal structure, we're not anticipating a lot of dilution from the $2 million in share payment. Again, we could close this without raising any more equity until post-closing, based on the commitment letter from Desjardins. So, there's been a positive response in the market. I think that there's a lot for people to understand from this acquisition and what it means, but this has been something we've been working on for a number of years. In some ways, this is one of the primary reasons why I founded Magna, and combined with our existing assets of Crane Hill and Shakespeare, and Shakespeare having the potential to build their own mill in the future, and the amount of resources we have between all the different assets plus these acquisition properties, we're creating a critical mass here. I think in one of the best jurisdictions in North America.
Jason,
So
thank you very much for that. When Paul reached out to me, your senior vice president, a couple weeks ago, said you guys had some news coming out, he wasn't kidding. That's a lot to digest. Rick, if we go back to Jason's due your diligence interview, one of the things that kept coming up was synergies and scale. I'm really interested to hear what you have to say about this release.
Well, I mean, that's really the story. This potentially, and I want to say potentially, eliminates one of my concerns around Magma, which was scale. As you know, Albert, big mining complexes make you big money, but have big risks. Small mining complexes make you small money, but have big risks. Scale is what you have to look for. You have to look for a circumstance that can make you a lot of money when times are good. So congratulations, Jason.
thank you.
It would appear that potentially, I don't want to concede it yet, but potentially you've addressed my primary concern around Magma. But let's get into it. What's your current market capitalization, roughly?
We're sitting around 200 million Canadian
In market cap.
in market cap.
Great. And how much cash and how much debt do you have?
So right now we have no debt.
Before the deal. Yeah. Okay.
No debt. As of June 30th, we had about 5 million in cash. We had some warrant exercises, 3 different tranches over the last since we announced that. So we have approximately another 3 million in warrant exercises since then. So from a cash point of view, we believe we can get to the end of the year, close this deal without having to raise any more capital. So yeah, we're in a fairly comfortable position.
What's your existing general and administrative burn before the transaction?
Well, it's growing. I'll admit that, because we have hired a few more senior people to round out the team. But right now we're sitting at about, with everything, probably about 3.3 million.
And how much will that grow with the acquisition? What will be the approximate 2025 G&A?
Approximately, again, and we haven't worked through all the synergies that, between the G&A that we currently have to run the McCreedy West mine and what we'll have corporately. But, I would guess it's going to come in somewhere between 4 and 5 million.
Let's call it 5, just so if we get surprised, it'll be a good as opposed to a bad surprise. And then before this acquisition, Jason, what is the indicated net present values from PEAs, PFSs, or FSs? In other words, if I'm paying $200 million for Magna, what do third-party studies indicate that the sum of the parts are worth at current metal prices?
That's a great question. Well, I think there's been some research been updated since our PEA that we released on Tuesday. And to be honest with you, I've been traveling since Tuesday. So I'd have to look and see what the latest is.
Fair enough. You can owe us that answer.
I'll have to be honest.
But we'd like it. What I'm trying to establish is pre-transaction, what do we pay and what do we get? So that one's in the mail.
Yeah, like prior to the PA that just came out, which I think was, a great improvement over the previous Crane Hill PA. SCP had a, sort of a NPV of, in the $700 million range. So again, I have to see what that's going to look like now with all this new news coming out on Crane Hill. But I think there's still, again, people can make their own decisions, but
I'd
still some
like you to
good
answer it.
value.
I'd like you to answer it differently. I realize you can't do it off the top of your head, but the way I'd like you to answer it is to say that the PV5 or PV8 after tax from your PEA or your PFS or your FS is X. You follow
Yeah.
me?
So from
both
our
both on Crane Hill and on Shakespeare.
yeah, so from our feasibility study at Shakespeare as a standalone project, done in 2022 at 850 nickel, we had an NPV after tax of about 140 million.
Right.
It doesn't sound spectacular, but where it really starts to get interesting is when you start looking at what about if you add in Crane Hill. Now,
Yep.
Crane Hill as a selling ore to a third-party mill in Sudbury, as per our current PEA that we just released, we have about $190 million NPV8 after tax, using 850 nickel and $4 copper. Now, again, not looking at any synergies or any differences in price tag, but what makes it very elegant is the capital costs. And we've been managing our PA that we just put out, and I can pull that up here in a second. So yeah, we managed to get our our overall capital cost down significantly for pre-production. So looking at ADEX of about 35 million net of any advanced exploration revenues, and about 27 million for pre-production capital costs after that. So very modest. And if you look at, what is the net after, if you take the revenues off of pre-production from that capital cost, it's only an additional 12 million. So, potentially some very low capital costs to realize that nearly $200 million of NPV8 after tax from Crane Hill. So,
right. So if you add the two,
spectacular IRRs.
right, and the sum of the parts relative to the enterprise value is very high. I think we established that in the last interview, and that's where I'm trying to get our students. In other words,
Yeah.
before the acquisition, we were getting more than what we paid for. Now, I want to talk about the acquisition. If going over the terms again, you have $5 million up front in cash. You have $2 million in share payments. You have, I'm sorry?
Yes.
Is that correct?
Correct.
You have another final payment, and you have some contingent payments. Accurate?
Correct.
Okay. And you have the ability to cover all of these with a $10 million term loan, which is to say you have the ability in the near term not to come out of pocket to get this done,
Correct.
with the exception of the share payment.
Correct.
So let's begin to get into how the cash comes in and how the cash goes out. Is McCready West, the current operation, a cash generator at current nickel prices? In other words, is it a source of cash or is it a use of cash? And if it is a source of cash, does it amortize and extinguish the $10 million loan? Where does the money come from?
So, I can't quote exactly what they reported as EBITDA because it's not audited. But what I can tell you is it's not a nickel mine, it's a copper mine.
Yep.
Probably 70 to 75% of the revenues in 2023 of that 317,000 tons, those revenues were generated by copper from the 700 copper zone.
Yes.
So the great thing about it is there's optionality to turn on the nickel.
Wait. Stop. Currently, does it generate cash or consume cash currently?
It has good cash positive cash flows. Like it will be cash flow positive. It will be able to cover the debt. It will be able to reinvest capital in the first year back into the mine at current operation.
Source of cash. And I realize this is highly speculative, but in your own plan with regards to the acquisition, does the cash flow from McCready West fund, in other words, does it extinguish the debt over 3 years?
Yes.
Okay, thank
Yes.
you. Thank you. Now, let's move forward. What we've decided is that this is a source rather than a use of cash. We have $5 million in combined G&A, and we have a series of capital expenditures around, sequentially, McCready West, Crane Hill, and Levac. Can we talk about the capital needs around those? How much, if any, of that will be covered by cash flow from the McCready West operations? And if not, what is the quantum of the cash needed to restart those? And what would you suggest the sources of that cash will be after the $5 million annualized G&A?
Yeah, so that's a great point. So in 2025, and these again forward-looking statements, I would expect that once we close the acquisition, we'll be able to put out a forecast and better guidance. But just in general, very forward-looking. In 2025, I would expect that we would produce positive cash flow. Some of that will go into the studies and the restart of Levac. Now, 2026 restart at Levac has potential based on the cash flows that we've seen historically in the last year and what we're planning on doing, potentially to be fully funded from McCready West, so a true bootstrap approach. Because the mine is in good shape and we are looking to develop a ramp to connect up, that's the largest, at this point with the plan, that would be the largest capital cost, is that ramp. So there is potential for that to be fully funded, and this would be after G&A and everything. Now, Crane Hill, again, we're still looking at a gold royalty or stream. Now that the PA is out, we're hoping to have something announced later this fall. Again, there's no guarantee, but that would be our expectation to potentially fund, the first, we'll call it the ADEX, that as per our PEA, that first 15-month period to drive the ramp into Crane Hill. So once that is done, there'll still be some additional capital, and that could again come from cash flow, or it could come from potentially equity, but that would be down the road, call it in 2026. So
will there be any development or deferred sustaining capital expenditure on McCready West in 2025 that exceeds the cash generation from you can see I'm getting to sources and uses in 2025 and 2026. What I'm trying to do is acquaint myself that you won't pull us through the floor financially.
Absolutely. I know what you're getting at, Rick, and in the back of my head, I'm just thinking of all the things my lawyer told me I can't say. But I'll tell you generally, I think what you need to spend additionally over what the budget was, let's say in 2023, and what they're planning on spending in 2024 for capital at McCready, I think an additional $3 to $5 million will go a long way. And it doesn't sound like much sustaining capital, but that would be more than double of what they've spent in the last, annually for the last 2 years. Now, it's not that it's completely capital starved. The mine is a unique mine where the mining, in some cases, is just lateral. So it's just extending, levels just another 50 meters, 75 meters further on extent. It's not like you have to drive a ramp and keep the ramp developing and develop new levels deeper to keep the mine going. When I was at McCready West in 2008, we were mining the 1950 level and developing to 2000. The ramp only goes to 2000. So since 2008, all the mining that's been done at McCready West has been between surface and the 2,000-foot level. So all ramp access. So it is a very low-cost mine. Now, there will be some new equipment needs to get leased. Especially if we want to increase production, And we will need to put some more diamond drilling in place. I believe exploration diamond drilling is needed. So there'll be a budget for that. But I think, something in the range of 3 to 5 million. And I think that can be covered. That can be covered by the cash flows based on what we've seen. And again, we'll give much better guidance on that. But I do not expect any, really, the biggest capital expenditure I see based on everything we've talked about today will be what we've talked about for the PEA for Crane Hill over the next 3 or 4 years. Subject to something changing and us wanting to start construction on Shakespeare, Crane Hill, and the approximately 35 million for ADEX and 27 million capital for pre-production capital. That is the largest amount of capital needed. And yes, if we want to move that ahead, and we think it's important to move it ahead quickly, we will need to raise money for that financing. But just like FNX did, McCreedy West financed the restart of Lac Mine and a big portion of Podowski. There's potential to do that again with McCreedy West cash flows. And once we close, I'll be able to give more guidance on that.
Rick, I can see you're winding up your next question, but we
Yeah,
are
Jason,
actually out of time.
Jason, I could do this for hours.
I know, this is great.
Perhaps we can have a rematch, but as Albert points out, he's my keeper. So I need to shut up, and I need to thank you for, first of all, congratulate you on this acquisition. And thank you for having the courage to face me in the rural classroom. We try not to make it confrontational, but these interviews aren't puff pieces. So thank you for having the cojones to show up.
Well, I appreciate the tough questions, Rick. Thanks a lot.
Jason, thank you very much. And yeah, let's do it again soon. Appreciate it.
All right, thanks.
All right, Rick. There's only one person that could have stopped me from keeping that interview going, and that is Ross Beaty, who has agreed to join us early this morning. So I'm going to bring Ross Beaty on, friend of the classroom, personal friend of yours, Rick. First, let's talk about the occasion. It's always great to talk to Ross, but why are we bringing him on specifically today?
Well, I made some statements in response to questions at the rural classroom with regards to local political challenges in Ecuador, which Ross disputed. Any excuse to get Ross, particularly on the summer when he would prefer to do other things, any excuse to get Ross in the classroom is wonderful. And so I said to him, why don't you dispute these publicly? And why don't we have a discussion? I will certainly use this invitation to question him about a whole range of things in areas, in companies that he has an interest in and that I have invested in as a consequence of his interest. So we will start certainly with local political conditions in Ecuador. And who knows where the discussion will go, but I guarantee it will be interesting.
Okay. And might I suggest we make a habit of making disputed comments about properties in which he is located if the reward is Ross Beaty joins us on the live stream. So let's bring on Ross Beaty. Welcome, sir. Thank you very much for joining us early in the morning today. Uh-oh.
You're muted, Ross.
Your mic, sir. Let's just take a look here. We cannot hear you right now, so it's not a mute issue. Maybe the wrong mic is selected. Or this is a ploy by me so we can win the argument. Yeah, we got a problem with, let's see, Ross's mic. So we're going to have to troubleshoot that. Rick, do you want to just address the audience while we try to do this?
Sure, absolutely. We'll do an audible. For those people in the audience who don't know, Ross Beaty has been a serially successful investor and mine developer. I've known Ross, if my memory serves me well, since 1982 or 1983. If my memory serves me well, again, I have participated in 14 or 15 companies with Ross Beaty. Some of them have been spectacularly successful. Lumina Copper, as an example, from, if my memory serves me well, a 50-cent private round to a liquidation in the $160 per share range. 200 or 300 bagger. The original Equinox, which, if my memory serves me well, I participated in at 25 cents and then 75 cents, was liquidated for, again, if my memory serves me well, $5.75. Pan American Silver, which we participated in the establishment financing of at 50 cents, subsequently went to $45. For many reasons, Ross is a wonderful human being, but he has also been an amazing source of profits. Ross is, like myself, ostensibly retired. And I think it's fair to say that Ross, like myself, has failed retirement. He is, unlike me, more successful at retirement in late June, July, and August, when the summers in the lower mainland of British Columbia tempt him and his wife, who I've known for many, many years, away from business. Beginning this time of year, when it begins to get dark early and it begins to rain, Ross comes out of retirement and goes back to work very, very hard. And he is extremely productive when he works. There are at least 3 current issuers, perhaps 4, where Ross is particularly active. His old mainstay, Pan American Silver, while he's not, to my knowledge, an officer, I do believe he's still a director. He is certainly a major shareholder. Certainly in the building of Equinox, his second Equinox, I would describe him at executive chairman as still, from my point of view, the most important person in that company. There is also Lumina Gold, which I suspect he will tell you is being built for sale in Ecuador, and we might get him to talk about Solaris, a company that he started, that he's handed off to a longtime colleague of his, Richard Wark, who is also a serially successful mine entrepreneur. The beginning of this discussion will center around statements that I made. Hi, Ross.
Hi, Rick. Can you hear me now?
Yeah, I mean, one of the challenges of doing an interview with somebody of my vintage is that they seem to have the same technology challenges that I have. So I'm delighted that between you and Albert, you worked those out. I was giving a fairly long-winded, but really extremely accurate description of your serial success. Also about the fact that, like me, you failed retirement, except in strong summer months. And also the reason for this discussion, which is to say that I made some remarks in the rural classroom concerning local political challenges in Ecuador that you disputed. Always the opportunist, I decided that would be a wonderful chance to get to interview you in the summer months, when you are often more interested in pursuits like kayaking than talking to me.
Also,
So let's get right to it. I had suggested that in your circumstance, like some other circumstances in Ecuador, while it would appear that you have political support at the center, that there were some regional challenges. I said that in the context of a statement I made that often in Latin America, our problem is with regards to social rents, the rents flow to the center and the regions literally and figuratively get the shaft. So tell me, first of all, that I'm wrong, and tell me why I'm wrong, and tell me how I can verify that you're right and I'm wrong.
Rick, you said 2 things that were wrong when you talked about Lumina Gold, specifically the Cangrejos property.
Right.
And I'm trying to remember what the second one was, but the first one you said that was wrong was that we had social issues. We had social problems. We had noise in the community against the project, and that's 100% wrong. The Cangrejos project has now been in our fold, working hard inside Lumina Gold for about 10 years. And I will say not once have we had any concerns from the local community, any indigenous issues, any artisanal mining issues. That was the second one there. You said there was, I think you said there were artisanal mining complications there. And that again is wrong. There's none at all. It's a very clean project. It's low lying. It's not in the high land. It's not in jungle country. It's quite close to Guayaquil. Quite close. It's about an hour from the port of Guayaquil by paved road. I mean, it's got a fabulous location. It's not around any indigenous communities. It's really set up to be a really nice big mine, and we can't wait to make that happen.
For the benefit of our listeners, talk a little bit about the topography and geography of Ecuador. What is Guayaquil, and why is that significant to you, and why should it be significant to our listeners? Then we'll return to the original discussion.
Okay. So Lumina Gold is a one property company. It has a property called the Cangrejos Deposit, which we've been drilling off for about 10 years and doing economic studies and social studies, environmental studies, moving it along the line from an early exploration project to a mine. We have defined a really big deposit there. It's over 20 million ounces of gold, very large, low grade, open pit. No metallurgical issues whatsoever. It's clean milling. It's a really nice deposit. It should be a mine, and it would be a mine anywhere else in the world. But Ecuador itself has been slow to the party in terms of the mining industry. They had a mining unfriendly government during the 2005 to 2014 period, and only about in about 2013 or 14 did they open up their legislation and made it much more encouraging for mining. The consequence of that has been that there's been two big mines in the country built, one by a copper mine by a Chinese company and one a big underground gold mine by Lundin Gold. So it's really on the map now. It's got a wonderful geological endowment. It's very, very rich in minerals. It's one of these Andean countries like Peru and Colombia. There's a coastal plain and then a very high mountain backbone of the country, and then it shifts down on the eastern side into the Amazon jungle. So it's highly hilly and mountainous in general, but there are places in the lowlands, for example, towards the Pacific Ocean, where it's much more gentle. And the Cangrejos deposit is in that area. It's in the southwest corner of the country. It's in rolling hills. Most of them have been settled by cattle ranchers, so it's got kind of scrubby topography, scrubby vegetation, and it's cattle ranching. Low value cattle ranching is the main economy there. So we have the deposit in this area. It's an old deposit. Newmont worked on it for years during the 1990s, and we acquired it in 2000 and about 2012 or 2013. And have drilled it off. And we're in the middle of doing a feasibility study right now and negotiating economic terms with the government that will be required to the extent that it goes and develops into a mine. Now, of course, Lumina Gold's strategy is not to build a mine itself. It's going to be about a $1 billion capital cost to produce 300,000 ounces or so for 21 years. That's the current model in the pre-feasibility study we did. So it's a really, really big deposit, suitable for a big company, and with the capital cost that goes with that. Lumina Gold's strategy all along has been to develop it to the point that we can de-risk it sufficiently for a big company, and of course sell it to a big company like we've done so many times in the past. Real simple strategy, and I'm sure it'll be executed one of these days. We've already had 3 trips to the finish line, and we just didn't get any of them across. So just kind of bad luck on a whole bunch of different fronts, partly COVID related. So that's great.
To put the rest of the discussion in context, in other words, the size of the prize, and I'm not going to ask you to make forward-looking statements. I'm going to ask you to make rear-looking statements. What is the market cap of Lumina Gold, if you know?
Yeah, it's around the 300 million Canadian mark, somewhere in that range, 250, 300 million. I don't really look at it day to day, but it's
I understand.
in that range.
And is there any debt in the company?
There's no debt, no.
How much cash is in the company?
We have enough cash to finish our feasibility study and a line of funding from Wheaton Precious Metals that will fund us right through to feasibility and possibly beyond. Most of that money is being used to do the feasibility study and complete some property purchases, some land purchases that we need to make the land package assured. We have all the mineral rights. We're now acquiring the surface rights in order to own the infrastructure areas and the mine areas and so forth. And we've got most of the land that we need right now. So we've been successful. The Wheaton deal, Rick, was a $300 million investment in the Cangrejos deposit, of which $50 million kind of was up front to do work we needed to do prior to making a construction decision.
And the compensation for Wheaton is a stream, a royalty, a direct interest in the property?
Yeah, it's a stream on some of the silver production, very modest amount. It cuts into a tiny portion of the cash flow from the property.
Got it. Got it. In effect, that becomes a liability, but it's a contingent liability.
Well, it's no more of a liability than issuing a whole bunch of shares at very very low prices to fund the current phase of what we're doing. It's all about cost of capital, and the cost of capital for a Wheaton deal was a heck of a lot less than raising shares or selling shares to the public.
Not trying to be confrontational, but in fact, having done a little bit of lending, a stream is a secured interest in a property. I agree with you that the terms and conditions that Wheaton offers up capital in are almost always, for good projects, more advantageous than diluting one's interest in the property. I'm just trying to understand the financial picture I'm getting myself into. But
just the only wrinkle on that line, Rick, is that there's no interest, right? It's a secured interest with and of course you never know when you're gonna provide the revenue. So to the extent that it's pushed out a few years, it's an infinite.
And it also isn't a $300 million liability. It's a contingent liability, which at present is $50 million. I get that. So the backward looking statement that I enjoy these, Ross, I have to say. And you and I are better having
sense of humor.
You and I are better off having these discussions over coffee than champagne on your birthday. The backward looking statement, now that we've established that you have a $300 million market cap, is what was the after-tax NPV of the PFS? I'm not asking you to say what the deposit's worth. I'm asking you to say what third party said it was worth.
Yeah, third party I think at the gold price we used, which was, I think it was 1,700. It was something like 1.6 billion or 2.2 billion. I forget which number. I mean, it's a crazy high number compared to the market.
Yeah, so there's a point in having this discussion. If you told me that your market cap was 300 million and the NPV was 50 million, I'd say, why are we having a fight? But the truth is, if you're talking about the fact that the NPV is well in excess of $1 billion and the market cap is 300 million, then I understand the nature of the conversation. So now we've framed the conversation, Ross. Let's move on.
Well, if I could just add one little add to that. I mean, our market cap hasn't changed. In fact, it hasn't really changed in 3 years, during which time the gold price has gone from, let's say $1,800 to $2,600. And the NPV, you're talking about the NPV today, I mean, at current prices, it would be, 5 billion, 4 billion. Like,
ladies and gentlemen, Ross Beaty and Rick Rule are both known for making forward-looking statements. Please understand that one for what it is.
Multiply the numbers. It's pretty simple.
I completely understand the leverage to the gold price, and I completely understand the fact that at $2,600, an NPV that was done at $1,700 is out of date. Yeah. I'm amused with your law degree that you answered that question, but I'm delighted that you did.
Misery loves company. I think what it shows, though, and I think what those numbers reflect, whether it's 5 billion today or 6 billion at today's price relative to a $300 million market cap, is that this whole sector, and Lumina Gold is a poster child of this problem. There is this gigantic disconnect between the gold price and the valuation of these junior companies that have really good projects, well managed, adequate capital. And for some reason, the market is just simply not buying these kind of companies. It is a disconnect greater than I've seen in my entire career. It shouldn't last, but I will say I'm very surprised that it has still not matured to the point that you've seen this big move in these high quality juniors with this giant move in the gold price. I really thought earlier this year there would be a catalyst of some kind to make these junior companies start to really move. The gold price, I thought, would be one catalyst. Gold price has done really, really well, as I expected it would, but you still haven't seen a move in companies like Lumina. It's a puzzle, but it is what it is. We have to live within that.
Perhaps I can illuminate some things for you, Ross. The junior sector in my career has been a massive destroyer of capital. The reason that you're in the real classroom is that the underperformance of the sector has tarnished unfairly the reputation of that 5% of the issuers, many of them affiliated with you, who have generated so many returns for investors, mercifully, including myself, that they have occasionally added luster to the sector. The whole point of the Rural Classroom is to assist the 82,000 subscribers at Rural Media about the difference between the high quality producers and about the rest, who, as you know, are valueless. Now let's get back to the
but Rick, you've been in this game a long time, like I have. Has that really changed that much? I mean, back in the 80s, let's go right back to when we first met in the mid 80s.
Yep.
You know, with the penny dreadfuls that were littering the Vancouver Stock Exchange with, you know, with what did they say in the Wall Street Journal? It was the sewer of the mining industry or something like that. But it not very flattering thing.
Scam
Have
capital
things really changed?
if you want the quote.
Thank you. Have things really changed? I mean,
That's
you know,
precisely
that's
my
the
point.
business. I mean, that's the game.
Precisely my point, Ross. The truth is that the people who were existing victims for the Vancouver Stock Exchange aren't victims anymore. So the cost of capital is too high as a consequence of past sins. The point of the Rural Classroom is to differentiate certain issuers from what Mencken described as the great unwashed. The idea is to enable a class of 82,000 speculators to segregate, in movie parlance, from the good, the bad, and the ugly. Even promotionally challenged people like yourself, who can't take up the market capital of Lumina Capital Lumina Gold from $300 million to some higher number in the face of advanced gold prices. But Ross, let me try and help you with
Cream
this.
floats to the top, Rick. It always floats to the top. Sometimes it just takes a long time.
And I'm trying to help you with that process. So let's get back to Lumina Gold. What you're suggesting to me is that the deposit, far from being locationally challenged, as an example in the Amazon rainforest or in the Altiplano, in the Cordillera,
or in the middle of the community,
is in the coastal belt, but not in the swamps, not in a river valley.
Right.
Tell me something about access and egress. Were one to build a mine there, are there convenient things like power, roads? What are the living conditions like? Paint a picture of the vicinity and help my audience in their own mind imagine someone building a mine there.
Sure. I mean, you'd be hard pressed to find a better place to build a mine in Ecuador. This particular area is rolling hills, generally well vegetated. It's got a moderate amount of rain per year. Much of the vegetation has been cut down to make fields for cattle grazing, really low value cattle grazing. There's no people who live on the property. The nearest town is about an hour's drive away on a good quality road. And from that town, it's actually less than an hour. From that town to the second largest city in Ecuador, which is Guayaquil, a seaport, is about a 35 or 40-minute drive. So the port that we will be using to export things and import things is about an hour and a bit's drive away, mostly on a paved road. You could not get better access. Having said that, there are no infrastructure issues. There's very, very cheap power. It's hydropower. There's a surplus of power in Ecuador, so we're talking very, very cheap power. They also have, of course, oil and gas production. So to the extent we need diesel for trucks, there's available diesel and it's relatively low cost. There's a good workforce very close by. We're not talking about building a big camp. We'll be using local community people. It's just a really, really good location for a big mine. There's no major conflicts of any kind. We haven't had social issues. We use all local people in the camp. I think we have 100 people at the camp right now, something like that, and they're almost entirely local people. So it's been a good project. The local mayor is supportive, and it's one of those good places to be. I wouldn't say that about everywhere in Ecuador. There are many places in Ecuador that have social issues because mining projects have come into conflict with indigenous practices and local tribes and so forth. and they have much more difficult times. But Lumina Gold's Cangrejos deposit is not one of those. It's a good go-ahead place to work.
So if you could help me segregate then, what you're suggesting is, as I'm understanding it, and please correct me if I'm wrong, as you note, I often am. In terms of Indigenous issues, there are not large Indigenous communities in your region, or you've already worked with them. Is that accurate?
It's the first. There are no Indigenous issues because there's none or very few. There's no doubt some Indigenous group that may claim the area in the way in Canada. Of course, there's Indigenous people who claim every single centimeter of Canada, and sometimes 5 times over, different groups. But we don't have that in Ecuador. Not where we are.
You may know I'm attempting to establish a tribe myself.
Why not?
For just such an activity. And as you describe it, despite relatively good access and egress, which is to say, within an hour of a tarred road and access to power, the area is sparsely populated, and you won't be disrupting a bunch of people's avocado groves or coffee plantations. In fact,
no. Not at all. We've already bought almost all of the land we need where we actually own the surface. So that's a very important, and that was a big de-risking thing. If we're going to build a mine, I mean, the default for us, of course, is if you can't sell it, what do? You have to either sit on it and wait for the happy day when things change, or you just go ahead and develop it. And there's multiple ways to do that. It's definitely a plan B, but we have to assume that we are going to be the builder and do everything we can to de-risk it to the point we can proceed. It includes getting a taxation and compensation agreement with the government. We're in the middle of doing that right now, settling royalty numbers, for example. The overall burden that the state of Ecuador will be taking from this project to the extent it gets built, de-risking it from the standpoint of the mining issues, the metallurgical issues, the capital costs, of course, the operating costs, the labor issues, water, power, all that stuff that you've already mentioned. You have to go through all of that stuff and making sure we have land rights so we can do what we need to do and we don't have to deal with an unfriendly landowner.
Well, that's a wonderful segue. The reason that I'm a Lumina Gold shareholder is because you and your team have dealt with some of these problems in other places.
Right.
Without going into exquisite detail, first of all, if you are trying to sell a project, it is useful if the market knows that you could build it yourself. If you had to build this yourself, describe to my audience, that part of my audience that doesn't know you, how many times you've raised $1 billion and built a mine in the past. I think that's useful to know. You're a credible threat to be able to do this yourself. So let's talk about that in other contexts.
Okay, and I'm going to make a correction to a statement I made earlier because I just checked on while you were expounding there on the world. I just checked the market cap. Turns out it's 200 million Canadian, not 300 million. So it's a
what's 100 million between friends, Russ?
Well, it just demonstrates the value to it's a crazy low value and it's kind of representative of the market. But I'm not fussed too much. I'm not doing any of the real promotion on the company. We have a very technical team, I'd say, that isn't driven by day-to-day share price. We're actually playing the long game. And the long game, to come back to your question, is to actually build a mine here if we can't sell it. Obviously, we're not going to sell this thing for current market price. We're not going to sell it for twice the current market price. So I have, and I'm the largest shareholder of the company, a very, very firm view on the value of Cangrejos and the value of this project. And if we cannot find a buyer at that price, we're going to build it ourselves. And so you say, how can we do that with a $200 million market cap if we need $1 billion? And all I can say to that end is, I have built a number of large operating companies. I founded Pan American Silver, was chair and CEO for many, many years. Pan American is now a $12 billion company with, I think its annual revenue is $2.5 or $3 billion. It's a very large operating company with 11 mines, and it has raised billions and billions of dollars to get to this point. My latest company that is an operating company is Equinox Gold. Equinox Gold started from scratch 6 years ago and is today a three point something or other billion-dollar company. I'm speaking in Canadian market cap terms. And it just raised $1 billion in May this year, for example, to buy out 40% interest on a mine in Ontario that we were building that was 60% owned by Equinox and 40% owned by another party. And we just raised $1 billion to buy them out. So it's I mean, I've raised lots of money in my career. There's no issue with that. But of course, the real trick is, you don't want to have to raise $300 or $400 million at 50 cents a share, which is where the stock's trading at right now. That will dilute the existing shareholders out of existence. And so, there's ways to do this that if the eventuality came that we would be looking at doing that ourselves, we would be using, we already have a $300 million stream. So obviously then the balance, if it's $1 billion CapEx, if that's what the feasibility study says, and the feasibility study is not done yet, Rick, that number came from the pre-feasibility study that was done a couple of years ago. I don't expect things are going to change too much though, quite frankly, but I haven't seen the latest numbers. And so you've got a $700 million gap. Obviously, this project would sustain at least $500 million of debt. And then you have to ask, well, what is the cost of that debt? Is it high? Is it low? Is it sideways? Debt these days is pretty low cost in the mining industry. And I think it will become even lower cost, especially to a country like Ecuador, which is seeking to improve its condition and will support export-import financing by development banks and so forth. So let's just say there's $800 million available there. The rest of the funding, you would either do it in one block or more than one block over time, over say the 2-year construction period, or you would bring in a partner. If we brought in a 30% or 40% partner to this project, all of a sudden you have that amount of capital that's available from a third party. So there's many ways to skin the cat here. If the bottom line though is you need to have a really robust project with no fatal flaws, and we're moving to get that status. We already have it, I think, but we're going to prove it when we do the feasibility study. That's one of the big ingredients to making this project real, and that'll be finished in April next year, I think, more or less about April next year. So it's not very far away.
And it probably isn't too forward-looking to suggest that if you haven't run into difficulties in the last 5 years since the pre-feasibility study, that the feasibility study using a higher gold price should more than substantiate the net present value numbers that you've given us, correct?
Correct.
Now, Ross, in 2 places that I have invested behind you, we have encountered national and I guess in one of them regional political problems. That would be in northern Guatemala and in central Argentina.
Yeah.
I know that you have been involved in the past in your career in torturous but successful negotiations with countries about fiscal agreements and fiscal stability agreements. In the course of the discussions that you or your management team are undergoing with Ecuador, do you believe that there will be reasonable revenue sharing between Quito and the region? Obviously, some of the problems that Tahoe experienced before you took on that silver deposit had to do with the fact that at least the social benefit of that project arguably flowed to the center and the northern regions, not that the communities in the immediate vicinity of your mine, but the communities in the region fell shortchanged. Are you going to be able, in the discussions with the government of Ecuador, to achieve a reasonable outcome for the region, in your opinion?
Yeah. So we're right in the middle of that right now, Rick. We're in the middle of negotiations with the government of Ecuador, the federal government of Ecuador, on the revenue split between what we will end up with and what they will end up with. This follows a number of other agreements that have been made recently with other companies in Ecuador that allow that issue to be put to bed for those specific projects. But it's a very important one. As to the distribution of revenue between the federal and the local regions, that is beyond our ability to do anything about. That's just simply a federal federal issue, as it is in every country, the distribution of revenue that comes into the central government. So we're not involved in that discussion at all. And Ecuador is somewhat different than some of these other countries like Brazil or Peru or Colombia, in that it's a very small country. It's a much smaller country than those other regions. And therefore, there's much more connection between, I think, the central government and the regional governments that aren't really that regional. They're not very far away from the center. So I don't really know the details of how the revenue is split, Rick, and I've never heard of it being an issue. The one difference today, though, as I said originally, from say 10 years ago, is that there are two big mines in the country that are already giving that revenue generation. And I think if you go down to the Fruta del Norte mine of Lundin Gold, you will find that the local region is a very happy region, that they are getting tremendous infrastructure value, employment value, social payments value from that mine. And if you go over to the Mirador mine that the Chinese company operates, it's a very large copper mine, you'll find the same thing. So mining today in Ecuador is a very different thing than it was 10 years ago when there were no big mines in the country. And you have this cancer of NGOs, environmental and more, not really environmental, because environmental NGOs are simply governed by the actual environmental impact of these mines. And the actual environmental impact of these mines is no different than similar mines anywhere. You just have to manage that very, very carefully. And you have to do the same thing in Ecuador you're going to do in the United States or Canada. It's the social NGOs that are all about sort of, social justice, and they just simply don't like mining. They are hostile to mining. There's some in Canada, there's some in the United States, and there's some in Europe. And they're inflicting themselves on local people in places like Ecuador, twisting their minds with kind of all kinds of crazy, hostile rhetoric, and they're making them anti-mining, and that's really hurting. And that's, for example, you mentioned Guatemala. That's exactly what happened in Guatemala to Tahoe. You had a whole bunch of left-wing extremists who ended up shutting that project down, and it's been very, very difficult for Pan America to get its social license back. It's taken now 5 or 6 years. They're doing it methodically, they're doing it rationally, and I think it's going to be successful. But whether you look at Guatemala or Ecuador or Peru or just anywhere today, you've got this issue. You've just got to deal with these groups who are trying to twist the local people into being anti-mining. It's a cancer that we have to live with.
You did a good job of anticipating my question, because I was looking for the possibility of similarities between Guatemala and Ecuador. I'm, because I've been a very long-term shareholder of Lundin Gold and a long-term investor with the Lundins, like I have with Ross Beaty. I've followed the Lundin Foundation and the interplay between the Lundin Foundation and Lundin Gold at Ecuador, and I congratulate them. I think they've done wonderful work, and I can confirm your statement that their relationships with the local community is spectacular. And they tell me that the federal government in Ecuador has been an important ally of theirs in improving the local circumstance, that it hasn't all been Lundin revenue. In fact, that some of the revenue, some of the social rents extracted by the capital have in fact gone to the region. Yep. Perhaps you could describe the juxtaposition between what has happened to you in Ecuador and what has happened to you in Guatemala and what is happening in Ecuador. Is it that in Guatemala there was some form of organized opposition that got into the community that's absent in Ecuador? What's the reason for these different outcomes?
Well, let me just give some background. The company I was involved with regarding Ecuador was Pan American Silver, but Pan American Silver acquired a company called Tahoe Resources.
Correct.
Pan American itself acquired Tahoe when this mine we're talking about, the Escobal mine, which had been a big producer of silver, was actually shut down by the government. So Pan American was not involved. I was not involved. It was an inherited situation. The problem there was that the Constitutional Court in Guatemala declared that the central government of Guatemala had not consulted the local indigenous nation called the Xinca. That was the problem in Guatemala. And as soon as they made that declaration, and I should say that the Constitutional Court was populated by fairly left-wing judges, and they were sort of, you could say, ideologically supportive of the notion of consultation, and it's an important thing to do. I don't want to de-emphasize it. You must consult with local people, particularly if they're indigenous nations, and you have to do it respectfully and properly, which was, I guess, not done in the case of Tahoe, or at least they declared it wasn't done. So they said the mine has to close until the local Xinca have been properly consulted. So Pan American then acquired Tahoe, and for the last 6 years or so has been in the process of 5 years maybe, consultation with the Xinca, which is moving forward. It's not the company that's consulting, it's the company that's assisting the government to consult with the Xinca. And so it's a somewhat slow process because it's government driven. But that's what's going on in Guatemala. You know, you just haven't seen that kind of thing in Ecuador. In fact, you haven't seen that sort of thing in most places in Latin America, but there are a few places. So that's what's going. That's what's happening in Guatemala, and it's a very different thing for us, certainly, because we don't have that indigenous component. Other places in Guatemala, in Ecuador, I mean, they do have that indigenous component. For example, Solaris, the Warintza project, is a very it's right in the heart of a indigenous area, and to the north there are some other deposits. Ecuador is very, very rich in minerals. There are other deposits that also have social questions around them because they are either in communities or they're in areas of indigenous concern. And there they absolutely have to take the high road and consult as much as they can to get the consent of the local people and the local nation to development. Sometimes you get that, sometimes you don't. Sometimes it takes a long time before you finally do. And that's how things work everywhere.
So it's your position that Lumina Gold, in terms of the region that you're in and in terms of your historical community work, does not and likely will not face the same type of local challenge that has faced all of us in other jurisdictions. Is that accurate?
That's accurate. Yeah, that's accurate. The other thing that is a real problem these days in I would say dozens of countries, particularly in the tropical belt around the world, is that you have, and particularly with the current gold price, is you have literally millions of people who make their livelihood mining gold at a small scale. These are so-called artisanal mining, or every country has its own name. In Brazil, they're called garimpos. And in other parts of Spanish Latin America, they have other names, but there are literally millions of these people. And what they do is they go into an area with a metal detector or a gold pan and look for gold right on the surface. The reason I say the tropical belt is because rock in the tropical belt weathers to soil, and many elements in the rock wash away. So rainfall is so heavy, but gold remains. Gold doesn't wash away. It's a heavy metal, and it just sits there at the surface, and it enriches. And so you can go along with a metal detector or a gold pan, and you can find this surface gold. And as soon as you find it, eureka! You rip it apart with any way you can, by hand or with diggers, bulldozers, machines, and it's all done illegally. None of these operations have any mineral rights. And it's a real problem for the mining industry because, of course, these people they just whip into an area, they rip it apart, they have no environmental controls whatsoever. They use mercury to recover the gold, they use cyanide to extract the gold in many cases. They cause tremendous, not only environmental problems, but social problems. They bring disease into communities, they overwhelm the local, often indigenous community with just their sheer numbers. In some cases, there are thousands and thousands of these people. It's a scourge. And of course, all this mess that they leave behind when they leave, because they can't go deep, they don't have explosives, they don't have large scale equipment the way a professional mining company does. They leave these ugly messes behind, walk away, go somewhere else. And of course, everyone gets tarred with that environmental damage, including responsible companies like ours. So it's a real problem. And It's not only a problem in Ecuador, it's a problem in Brazil, like all through that whole belt, the Amazon belt particularly. It's a problem all over Africa. It's a problem in Asia, and it's hard to deal with. The problem there is, the second problem is, of course, these are all local people. They all vote. We don't vote, and so they have a natural, affinity to the government, which is reluctant to shut them down, because of course there's a political force there. So it's a problem, and we don't. So that was a long-winded story about our, sort of a pet peeve I've got about our artisanal miners. Luckily, we don't have those at the Cangrejos area like they do many other places in Ecuador.
And for the benefit of the audience, this is due primarily to the lower grade nature of the deposit and the fact that it hasn't eroded off and formed alluvial deposits? Or why is a 20 million ounce deposit untroubled by artisanal miners?
Right. There's two reasons. The first is it's low grade, as you put. So there's you can't take a ton of this rock or a few pounds of this rock, put it in a gold pan and find free gold. You just can't do that. The gold is associated with sulfide minerals. You actually have to have a mill to extract the gold from the rock, and that is something local people can't do. That the second reason is the weathering profile of this particular lowland area of Ecuador means it hasn't had the uplift that other parts of Ecuador have had, particularly on the eastern side of the Andes, and you just haven't built up a significant soil gold profiles or even river or stream gold profiles around the Cangrejos area the way you have in other places, all through the Andean belt in Peru, Colombia, Ecuador, and so forth. That's just the nature of the geological history of the country and this particular location.
So for the benefit of our listeners, what you just said is that you haven't had the uplift and the subsequent erosion, which would concentrate the gold in placer deposits,
right,
that would be attractive to artisanal miners. Is that correct?
Correct. There is some, there have been a few attempts to kind of get into the area by a few artisanal miners, but it's an insignificant concern to us. There are none today, and when some come in, they kind of come and go.
And before I move on, refresh my memory again with the answer to two hitherto unanswered questions. The new valuations associated with Lumina Gold will come, you suggest, in the calendar first quarter or calendar second quarter of 2025 by way of a definitive feasibility study. Is that accurate?
Q2.
Okay. Okay. So let's just say June, just to make it easy.
Yeah, probably be before that, but let's just say June.
Yep. Yeah. And the second thing is, when do you think that you might be able to announce what the negotiations with the government of Ecuador around the fiscal terms and conditions will be?
Q4 2024.
Okay, great. So, ladies and gentlemen, we talk about the sequential answering of unanswered questions to increase the market certainty around the net present value of a company. The answer that we just got was Q4 for the fiscal stability agreement and other agreements, and as late as June 2025 with regards to a much more definitive valuation relative to market cap. Did I state that correctly, Ross?
Yeah, you did, Rick. I mean, there is some uncertainty about the Q4 date simply because we are in the middle of negotiations right now. We don't know when they're going to end. Yep. Things happen with governments, but it's a great government right now in Ecuador. Very go ahead, very pro mining. They want to make the mining industry a big contributor to their GDP, to their employment base, their financial base. It's capable of doing that, but they are not. Believe me, they're not. They don't bend over easily. They're smart people. They know what they have in their country. We have a very fulsome negotiation with them right now. And we are trying to maximize value for our shareholders, and they're doing exactly the exact same thing for theirs. So there's no guarantees of that, Rick, but certainly that's what I'm hoping it will come out. As for the feasibility study, I would be almost certain that it will be Q2 next year, latter part of Q2. And I expect that when we complete the negotiations with the Ecuador government, it will be a disclosable event And that's why I do expect it on a balance of probabilities. I'd say I do expect it in Q4 this year.
Ross, other than the fiscal agreements with the government of Ecuador and the feasibility study, are there other things that are going on that will answer unanswered questions that will, I mean, within your control? Are there other things that you're working on that you think will materially increase the market's understanding of the deposit? And then as a consequence of that, potentially increase the market capitalization? If so, what are they and when might we expect them?
Sure. I mean, there's going to be an analyst tour in October, for example, not too far from now. And we're going to do a combined tour with Lundin Gold because we're actually in the same southern part of Ecuador as Lundin Gold. Lundin Gold's towards the Amazon area, much more densely forested and a lot more rainfall. We're on the Pacific side, but we're not that far away. You can get from one to the other in a couple of hours. I'm going to say, as I recall, it might take a little bit longer, but a couple of hours on a paved road. It's really good infrastructure in Ecuador. So that's one. It's an analyst tour and investor tour. Then there is probably going to be some new analyst coverage. The one thing that has been a surprise to me over the last few years is how little Lumina Gold is covered by the investment community. And I can't bother to give you any particular reason for it. I just don't understand it myself. But the bottom line is,
I understand it. You don't do a lot of financing, so there's no fees.
We don't do it.
I understand it perfectly.
Well, that's probably true. In any case, happily, and maybe because they are sniffing something that might happen next year, we will get some coverage. BMO is now covering us. We have two other firms we're fairly sure will launch coverage in the near future, and that could be a catalyst as well. Simply getting this big deposit, this giant deposit better known is important to me, to our shareholders, and to the broader community, particularly when we're moving from this real, it's a really significant step doing a feasibility study on a deposit like Cangrejos, because when you're doing these feasibility studies, you really are de-risking it. You are at a very high quality technical level, defining the recovery, the grade, the mine plan, the capital costs, the operating costs. All of this needs really high quality definition. You're doing a lot more detailed engineering, and you're getting your piping sizes, your mill sizes, all of these details for a really big open pit operation like Cangrejos. So you really truly do de-risk it. Pre-feasibility studies are pretty good depending on how well they're done. Preliminary feasibility, preliminary economic assessment, so-called PEAs. It's just kind of like you're putting parentheses around value, but you're really starting to shrink down into detailed numbers, highly defendable numbers, and we're doing that right now. The guy who runs Lumina Gold is a guy named Marshall Koval, who is a real rock star on engineering, on detail management of these things. He's done it with me. He's been with me for over 20 years now. He did all the work on the Lumina copper stuff, which was so credible that we sold 4 of these big mines to big companies, and they took our numbers and just accepted them. So he's a very credible guy. He's smart. He's working hard on the feasibility study right now, getting it done, and also doing all the things that an economic project needs to be able to command a premium valuation, and thus, in our plan A, a premium takeout value.
Thank you for that. Note to students of the rural classroom, BMO is Canadianization for the Bank of Montreal, whose capital markets team is probably the most important mining capital markets team in Canada. Second note, refer back to interrogating a mining company to understand the value progression from a preliminary economic assessment, which is a target, to a pre-feasibility, which increases the markets and your knowledge, and the bankable feasibility study, which is probably the best document that you are going to be able to get in terms of removing uncertainty. Remember too, that even when you look at a bankable feasibility study, you have to pay real attention to the assumptions, and you have to add apples to apples. I've been looking at Ross's bankable feasibility studies since his hair was dark, and since I had some hair, and I can confirm that they've done a good job on those. After that long-winded soliloquy, Ross, in conjunction with the bankable feasibility study, are you doing any exploration or development work that would increase our certainty? As an example, drilling at tighter densities, that would increase the size of the deposit. Is there anything that's under your own control, not a fiscal agreement, not a political agreement, that would enhance the value of the project in the feasibility study, other, of course, than the advance in the gold price?
No, I will say no. We've done that stuff already, Rick. The deposit is wide open. It's already 20. I think the pre-feas economic model had 22 or 23 million ounces, of which was going to be running for 25 years at around 300,000 ounces a year. I mean, those are big numbers. So if you add, it's just a sea of low-grade gold mineralization at this deposit. It's a granitic host, and it's one of these things that's just got gold everywhere, but regrettably not in really high grades. It's a low-grade deposit, but it's very large and clean milling, and it responds very well to recovery. So it's just going to be one of these big low-grade gold mines that produces a lot of value. And don't forget, grade is one thing, recovery is another. Capital costs, operating costs, strip ratio. There's a whole pile of things that makes a mine valuable. You can have a high-grade mine that's completely uneconomic because you can't get the gold out. Right. And you can have a really low-grade mine, like, for example, Equinox has a couple of the lowest grade gold mines in the whole world. We're making money at 0.3, 0.25 grams per ton. This is a few sand grains in the bottom of your palm in a ton of rock, and we're making money at that. So you can't just look at grade, and I think it's one thing that has slowed the development of Cangrejos in terms of the mind of big companies. They look at it and say, "Oh, it's very low grade." But once the numbers come out from the feasibility study, that'll confirm this is a very profitable deposit, big, long life, low cost. The all-in sustaining costs for Cangrejos are going to be around $800 an ounce. The pre-fees have them even lower, I think 600, but I'm going to inflate that number a little bit. So it's just going to be a demonstrably big, low-grade and profitable deposit that any big company should want to own.
So for the record, ladies and gentlemen, you will recall in earlier discussions at the Rule Classroom that we talked about the fact that we want tier 1 deposits, which I defined more loosely than Newmont defined, which is to say in excess of $10 billion US in situ recoverable reserves and resources at today's commodity price. Check. Sounds like we have that.
In space.
We asked that the deposit potentially be in third-party discussions in the lowest AISC quartile in the industry at $800. Certainly, you check that. And we ask that the deposit be in the best quartile worldwide in terms of return on capital employed, but at least a 25% return on capital employed. We will likely find that out in the second quarter of 2025. Is that accurate?
Yep.
Great. There you have it, ladies and gentlemen. You have a serially successful entrepreneur. You have an incorrect criticism of the deposit from me. You have a potentially tier 1 deposit with regards to size, with regards to all-in sustaining costs, and potentially with regards to return on capital employed. And you have it in a $200 million Canadian market cap, $120 million in our spendable money. I think that's a wonderful story, and I'm delighted to bring it to you. Ross, hopefully next year I'll make another misstatement about something else, which will cause you to return to the Rule Classroom. I've enjoyed the discussion. Thank you, sir.
You're welcome, Rick. It's always a pleasure. I have immense regard for you and your whole life of trying to make investors money, and I commend you for that. And I'm more than happy and greatly honored to be able to participate with you here anytime.
We hope to bring you back to Boca Raton for the Living Legends panel next year so that I can grill you live as opposed to online.
Well, that's harder because that's the middle of summer. So, I have my limits.
I understand. I understand. I have my ways.
You're
Very
just going to
good.
have to make up some really bad stuff, Rick. Ross, thank you so much for taking time with us and clearing that up. Always appreciate that. The people in the classroom are very happy. And I want to remind everyone, we got our Tier 1 Asset Bootcamp coming up on October 19th. Go to bootcamp.ruleclassroom.com for details. Gentlemen, thank you so much. This was great. Appreciate it very much. And I look forward to next time.
Thank you very much.